Welcome to the Micromobility Podcast. I'm your host, Prabin Joel Jones. And today I have a company that I've been following for a very long time. Super impressive founder, super impressive business model, very different from others. So it's a company called Pony from France. If you were around in 2017 and associated with the industry 2017-18 times, you definitely know them. If you're new to the industry, you probably might not even heard about Pony, but they are an impressive company that everybody should have on their watch list. So today I have Paul-Adrien, who's a founder of Pony. Welcome to the show, Paul-Adrien.
Yeah, thank you very much, Prabin. I'm very pleased to be here with you today. So looking forward to the chat.
Great. We've always had a great chat, so I'm super positive that this is going to be an incredible chat. Let's get started with you. I mean, tell me about you. How did you get to found Pony? Tell me about your journey.
Yeah, so very quickly, I have a engineering background and specialty in financial mathematics. So I was working in London as a what we call a quant, so on a trading floor doing mathematical research on interest rate derivatives. And this was, a lucky accident. I mean, my calling has always been to be an entrepreneur, and I've known this since very, very young. It just happened that at the end of my degree, I had to do an internship to validate my degree, and during this degree, after just a few weeks, they offered me a position for which I was, took me by surprise, and I ended up accepted. The team was fantastic, and I learned a lot for like 6 years. I spent there. But then eventually the deep will to create and build overwhelmed and was overwhelming, and then I ended up starting first company with my co-founder with also my wife Clara and another friend, which was a drink company. We did that, so I didn't leave my job at the time. We did that for about a year or so. Then Clara and Mehdi, my friend, they went full time on this drink company, Seabury. I stayed at my job at the bank, and I started working on new ideas as a side project, as we called them at the time. And one of the stuff that excited me the most was Pony. And the reason I fell in love with the industry very early on, so we are talking here 2015, 2016, was the ambition and the impact such an industry would have. Mobility is like where people spend the most time almost in their day. It's like 1 hour and 5 minutes, so after work, and it's like a very significant amount of their time. And it's also a very significant amount of their money. Depending on the countries, is like number 1 to number 3 area of spending. But in France, it's number 2, for example. It's just after housing, but it's more than food. People would spend more to move around than to eat. So it's hugely impacting our daily life. And, living in London, I felt like, in fact, what happened is one of my cousin, was there learning English at school, and then for a year, and then when he left, he gave me his bike, and I never rode a bike in London ever. It didn't feel at the time like something someone normal would even consider. And I tried, and it's changed my perception of the city. I was living in close to King's Cross Station, and I was walking nearby Marylebone Station, and I was traveling either by bus or with a moped. And the two areas felt completely disconnected in my mind. And the first day I did this bike ride, I discovered that many places I knew were connected in a certain way, and I could stop anytime. It felt like very refreshing, very pleasant, and also surprisingly super fast. In fact, faster than public transit. And that's when I realized I was like, actually, this will be eventually the main mode of transport of any big urban, area across the world, and it's meant to happen. And that's where I started working very hard on why is it not happening and how we can contribute to this. And at that time, I was also doing. So it's a bit geeky, but electronics as a hobby with a friend. So we were building like some connected objects, trying to play with IoT and build like some IoT stuff for a place. And then it turns out it was like, yeah, in fact, we can connect any bike lock for $20, making it like essentially a share bike.
Yeah.
And then you can have like millions of bikes shared for like just 20 or so dollars per bike, and making it like an incredible infrastructure that would definitely change the way people move around. And so that was the initial intuition, and how we started really looking hard at the space and work on a plan to make it happen.
Okay, but which year did you start Pony?
So in fact, I I pitched the idea to friends of mine at the bank in December 2016, which is when we decided we would go for it. And then I left actually my job in April 2017, and that's what the adventure actually started for real. Yeah.
So you raised some funds to
Yeah.
get started?
At the time, we I called a few friends doing like some BA checks, and we raised at the time 200K pounds. They forced me to put 30K of my own money, which is all of my savings, which turned out to be a terrible idea because it was a very stressful experience. I had like actually zero money left in case anything got wrong. So, but yeah, so 240K. That was how we got started.
Yeah, and in fact, this was one of the advice that you gave me when we were chatting about one of my companies, and you said, "No, don't put your money."
Yes, no, it forces you to there is really a risk that you make bad decision because of the implication you would have on your personal life if you have absolutely no safety net. And I'm quite lucky that, in fact, before leaving my job, I with my wife we bought a flat in London in a street that ended up making up 40% in 2 years. So we made fantastic return on the flat, but did we not? I think I don't know if we would have survived the first few years of Pony, where we had zero salary actually for several years. And so that was a tough time, but.
Yeah, so you started in 2017, and I remember, I don't know, it was 2018 or 19. You immediately started with Adopt a Pony concept, which was super fascinating, right? I mean, everybody were like, let's raise, insane amount of money, and everybody were raising, right? Dot was like raising 20 million, Voy, I don't know, 50 million at that time, and you were like, let me raise money by, just letting people adopt a bike or scooter, right?
Yes.
Can you tell me about that thought process and probably explain the model as well?
Yeah. So Pony is very unique in the space in many ways, and one of them is indeed the financing model for the vehicles. So basically being like a first-time entrepreneur, we had this dream company, but I was barely part of it, and and it was not a massive success. I didn't have million to invest in seed myself, and a lot of friends and credentials to do a big seed round right away. So we had to think deeply about the fundamentals of the business and how it's going to look in the future, and what is the target in terms of like equity story and financing of the vehicles. What we realized very early on was that bikes and scooters obviously are not going to return a 10x, or like obviously not a 100x, and not even a 10x, and not even a 5x. So if you use VC money, which is the only money you can raise in equity at that scale, to finance your fleet, then you're doomed to disappoint your investors.
Yeah.
you will have eventually to leverage this equity with other sort of financing, which is looking for lower returns, but is accepting a lot less risk. Um, and this is how you traditionally finance, like car rental fleets, or trains, or planes, or highways, or hospitals. Like it's asset-backed financing. So the asset is a collateral to the loan, and if you don't pay back, the lender is taking the assets, and the top company with the equity is basically worthless, because then you have no asset anymore, and then so the equity guys are completely wiped out, and
Yeah.
and the lenders are like trying to recover some of their investment, dealing with the assets. So that's the traditional way of dealing with capex intensive businesses like ours. But the challenge with this is those lenders typically don't make a lot of money on those deals. As I said, they're dealing with a lower return expectancy. They want lower risk. So they ask for two things. They ask for a lot of track record. So you need several years of demonstrated, this asset building, like providing, demonstrated returns. And they also need certain scales. They won't go for deals like typically lower than 30 to 50 million,
Yeah.
So those guys are out of the picture. And we were thinking out as like, okay, but then how can we find investors that would be interested to financing those assets, and for which those assets would be very good collateral, even though we don't have a lot of track record, and it's not clear who is going to buy them if you fail, and then what are you going to do with them. And uh, turns out the guys for which those assets are very good collateral are our users. They pay money every day to use those assets, so it clearly means that they see the value in those bikes being around, and they clearly they understand that the bike is for. And it's also for them, collecting a bike or a scooter if something goes wrong feels very easy and natural. They've been using those bikes, and so we. So we thought, okay, in fact, we let's see if our users would be interested to help us, build the scheme and develop it. And so that was from a financial strategic perspective, one of the key elements of us working on this. Other element was also that at the end of 2017, so we launched Adopt in the summer of 2018. And what happened is at the end of 2017 was that the industry got a lot of funding from big VCs, in fact, so much funding that it led to crazy decisions being made, scaling happening way too fast with, in fact, the wrong model of vehicles, no operational expertise, the legal framework not being ready, not establishing the right partnership with cities. So quite clearly, something that was that didn't. People rejected, in fact, the industry at the time. At end of 2017 was very bad. People were. We created Pony thinking we would have a very positive impact to the world by bringing, a bike in everyone's pocket, and it would be super cool. You want to use it, great, it's there. You don't want to use it, you keep what you do. But at least it's a new form of freedom. It's a new form of transportation, and it's, how can you be against, bikes being around for people to use if they want to? What happened in the industry was so bad that we were met with a lot of rejection, and we wanted to also find a way to rationalize the perception of the industry. And like, guys, it's just like, let's not freak out. It's just a bike that people can use. and it's not like some shabby company trying to abuse the public space to
Yep.
greedily make some money, and we wanted to recreate a sense of community and a sense of shared ownership. We talk a lot sometimes about the expression, it's a shared mobility. There's nothing shared with, traditional model. And the goal was to create truly shared mobility. And so we launched, this model where we basically offered some of our users to buy a vehicle, and every time this bike is being used, so they become really owner of those bikes, and every time it's being used, they get a percentage, 50% of the revenue, actually. Yeah.
Okay. But there's like, if you adopt a pony, that pony is actually linked to you. So, okay.
Yeah, and so that was very important because we wanted to make something very simple. We wanted to make something with a clear sense of ownership.
Yeah.
The scheme doesn't belong to us. It belongs to the users. It belongs to the people that live in the city. And if this bike is there in front of your place, it's not because like some crazy headquarter somewhere or wherever decided they want to conquer this part of Europe on a 10 years, on a 2 years roadmap. No, it's because one of your neighbors thought this was a great idea and they wanted to invest to make it happen at a larger scale, So we felt like transfer of property was a key part of making it something truly shared,
Okay. And was there a payback period for this? So, say that I'm adopting a pony, there's a scooter or a bike linked to me, and if that bike is used, I probably get a percentage, right, or
Yes.
of the revenue.
50% of the revenue. Yeah.
Oh, okay. That's pretty decent. So, and maybe I have a payback period over, I don't know, 1 year, 2 year, 3 year, whatever period that is, right? And how does it work? So is there a promised payback, or is it like, it's revenue forever? How does it work?
It's revenue forever. It's your own bike.
Okay.
So obviously that we cannot promise anything. We don't know what's going to happen. Maybe people are going to use your bike. Maybe they won't. So what we do though is we provide like sort of a warranty. We guarantee that whatever happens, how bad your bike may be damaged for the first X years or X number of rides, we make sure it's fixed. Which is basically not directly, but if you do the math, it means that it's guaranteed return. You're at least going to make your money back. And then how much are you going to make on this investment is, it's up to luck. So in some cases, actually, people got their money back and they got some return. But in some cases, some people did 3x, 4x on their investment, which is completely insane because we had this 50-50 share of revenue, and in some cities, some assets, especially scooters, when we launched scooter, the ridership was, it's still actually, but off the charts. And the initial deal was very generous. And so, some people, they got their money back in 5 to 6 months, and 3 years later, their scooter was still running. So, and which actually led to something interesting is that since the launch of Adopt a Pony in 2018, we never managed to clear the waiting list for people willing to adapt. It's and it's been like helping us grow and finance the fleet, every year since then. Yeah.
But on the other hand, you're locked on a 50-50 contract. Right.
That's the downside. So the issue with Adopt was that at the beginning, obviously, we had no track record ourselves, so we had no idea how much the scooters are going to last, or what's going to ridership going to be, and so the initial deals were way too generous. If the asset owner is doing 4 times his investment, it means yourself on the other side are not having a good day, right? So and so quite frankly, it's true. Adopt is expensive. But obviously, the more track record you have, the more you adjust all the parameters to make it like a more sensible.
Do you have a crazy story about Adopt a Pony? Did you I remember you opened it up and there was a very short period when everything was sold out, right?
It's so many stories. So the first year we launched Adopt a Pony was 2018. It's never been done before,
Yeah.
So shared bikes were already crazy new, So we were
Yeah.
at the time in two cities, which is Oxford in the UK
Mm-hmm.
and Angers in France, and both of them are like not massive cities. It's not like the most tech savvy people. Well, Oxford maybe a bit, but and we launched Adopt. We just put a button on the website on the app, sorry, saying, "Yeah, guys, adopt a pony." And if you clicked on it, it would say, "Yeah, you buy your bike, you get 50% of the revenue, and then you
Mm-hmm.
can ride with a discount forever." And so, what was surprising right away, even before we launched, is that all of our users would click this button, and all of our
Yeah.
users is a lot of people, because the magic of shared micromobility is you get a lot of users very fast for free. Like
Yeah.
a good number to have in mind is that a normal launch is 10% of the city population downloading your app in the first 4 to 6 weeks of you being in the city.
Wow. Okay.
And that's with no marketing, zero
Yeah.
budget. Just putting the vehicles at the right place, clean, in
Yeah.
good shape, you would get 10% of the city downloading your app for free. And then you put this button, and then suddenly, like what we saw is like 90% of them would click on this. So
Mm-hmm.
it's 9% of the city. And then one day we say, okay, yeah, that's today. So we launched the stuff, and then we were like, okay, we're gonna see how it goes and everything.
Yeah.
And then half an hour later, the phone starts ringing, and it's like, yeah, the seat is done. I cannot adopt. And like, oh man, okay, let me have a look and everything. Actually, sold out. So it
Mm-hmm.
was not a big sale, but
Yeah.
it was 100 bikes in Oxford and 100 bikes in Angers. It's
Mm-hmm.
like 30 minutes to sold out. And since then, the biggest sale that we did was in December 2020.
Mm-hmm.
We sold over €1 million in 5 hours. And the
Wow.
first 5 minutes were 50K every 30 seconds. The Stripe
Damn.
graph is boom. It's absolutely crazy. And yeah, sold out in five
Okay.
hours. And since then, it's been the case every time. Like we would never run a sale more than
Mm-hmm.
I think 8 hours or 9 hours before it sold out.
How much did you raise in total through Adopt a Pony?
More than 4 million in total.
Okay. And are you still doing it, or?
So yes and no. The issue with Adopt is, as you said, it can be expensive if you
Yeah.
don't package it properly. The other problem we had was that even how successful it was, it never felt the top priority at the time to invest enough on the platform to make it like a very nice and very user-friendly experience. And so what happened is that a lot of people gave us a lot of money, wanted to be very involved and contribute to what we were doing. And we were letting them down a bit by not making it a priority to work on their user experience, which we couldn't do because it would have no impact on our business. And at the same time, the operational side, running the scheme, renting the vehicles, repairing them, charging them is a very hard business
Yeah.
and required all of attention. Um, so, uh, so in fact, we paused this last summer when we
Mm-hmm.
raised 10 million in asset-backed financing, which took over as our main mode of financing, and we deployed 10 million since then in asset-backed financing. But we're going to go back to this very soon. But maybe instead of building like what is a full, essentially crowdfunding platform inside our own website,
Yeah.
maybe instead work with partners to have like a nicer experience and something that is a bit more deserving of what people are bringing us as well. Yeah.
Yeah. In terms of hardware, you started with, I mean, you had scooters and bikes in the mix. How did that evolve?
So,
What's the mix of bikes and scooters
so
today?
before being called
Yeah.
Pony was called Pony Bikes.
Yeah.
So our intuition from day one was it's going to be e-bikes. E-bikes are the way to go. When we launched in 2017, e-bikes were like is way too expensive. So with 200K, you don't afford e-bikes, and e-bikes were not such a mature technology at the time. So we went with pedal bikes, thinking, we would learn, how to operate and
Yeah.
build the app and build and everything, and then raise some money and then go build e-bikes. In the middle, scooters appeared, and quite frankly, I was skeptical of scooters at the time. Um, and then we tried them in February 2019. And in a city like Angers, for example, where we've been running since 18 months already, um, adding, so we had 500 pedal bikes, mechanical bikes, and adding 50 scooters would double the number of users in the city
Yeah.
in 3 weeks. So completely insane in terms of adoption. Yeah, it was really a shock. And looking at it, it was clear that it was bringing a lot of value to users. People that would never ride a bike would, because they didn't feel comfortable on the bike, or they didn't have they were not in good enough shape to ride pedal bikes, mechanical bikes, and they were very happy to have the scooters, and it was bringing a lot of value. And so from this day on, scooters were really like a key part of our strategy. And then we deployed a lot of scooters. I'd say scooters became like 80 something percent of our fleet.
Okay.
Until we finally managed to our dream of building a good e-bike.
So this 80% was probably around 2020.
2000, no, more than that, 2022, I think. Yeah,
Okay.
80, maybe even 90% of the fleet were scooters.
And what's the percentage today?
No, it's gone back to 50-50 since
Okay.
I think this month. What happened then is we worked very hard on e-bikes. So we tried working with third-party vendors for e-bikes, and quite frankly, they was not up to the task. Like the big brand names and as well smaller players, we bought actually quite a sizable fleet. We bought 1,300 e-bikes from one player, and in fact, we're still having legal implication of the poor quality of the product.
Yeah.
The bikes were terrible. They would break all the time. There were bugs. So at the time, we used to have like 2 people full time just unplugging and plugging back the battery to reboot the bikes. It was an absolute nightmare. It was almost dangerous, to be honest. So after a few months, we decided to stop this experiment when we realized how bad it was, and think about can we find the right e-bike, and if not, what would it take to build it? And then that's when we worked on the crazy plan to build like our own cargo e-bikes. It's a long tail, which felt like quite crazy because at the time it was like I don't know, 10 people, a few $100K in funding. And yet this product arrived in the market in 2021, I think. Yeah, it was not right away the big hit. I think it was maybe too discreet and maybe not a big enough fleet. But then when we scaled the fleet and make a few changes, it's been suddenly like an absolute bestseller. And now we actually multiplied the size of the fleet tenfold in the last 18 months. And now we are back to, in total, we have about a bit more than 10K vehicles. And it's a mechanical bike are like a very small number of that. And then it's 50-50 e-bikes, e-scooters.
Okay. And so the e-bikes are completely in-house built, right? You designed it, you built it, right? How big is that team?
3 people. Including custom battery design, including, so it's a crazy bet. I think we've been very lucky in the process. I know some of our competitors have wasted millions in building their own hardware. In our case, I think we not having a lot of money forced us to be very practical and very pragmatic, about what was necessary and what needed to be done to have a bike that's fit for our use case. and not like a product that was the phantasm of like the of what like a cool shared bikes would look like. I think the Bird scooter is the infamous example of a very poorly designed product in terms of like not being swappable at the time where it was absolutely obvious it should have been. But it's impossible to deny that from a purely aesthetic point of view, it was great. You know what I mean? And so it clearly form above function, where the double pony, the V1, as we call it now, it was definitely the opposite. Aesthetically is like, it's a bit crude, but yes, it's fantastic in terms of like user experience and in terms of like margins and repairability and reliability is a very good product. Now we're working on the V2 of this product, which this time is going to be a bit more refined.
Better looking.
Yeah, and so we will be launching like we will have a first test batch in the streets in starting September. And I honestly think that this new e-bike you can launch in any market in the world, and you take over in 2-3 weeks. Any competitor, including Lime. Yeah.
Oh, okay. That's a massive claim.
Yes, Lime. I'm not gonna lie. I'm in Paris right now, so where Pony doesn't operate, I'm using Lime every day, and it's a great product. But the long tail, being able to carry a passenger is just a game changer.
Yeah.
And so I think we will see how it goes. But and in fact, we're facing Lime today in a market which is Nice. They have a much bigger fleet than we have right now, because we are in transition from this V1 version to this V2 version. So we are not full scale yet, and waiting for this V2 to be validated and deployed. But still, like we even with a much smaller fleet, we do 40% market share, which is a bigger share than our share of e-bikes. So ridership per day is better on a smaller fleet, which normally doesn't make any sense.
Why do you think so? That is,
I think is the vehicle itself, and the ability to carry a passenger is in fact we don't have a precise number, but I think over 50% of our trip are 2 people. And why is game changer is because it's twice as cheap. And it's such a fun experience. You talk with people, and then if you are 2 and you need to move around, finding 2 vehicles can be tricky. So just having to find one is so much easier. And also it's in fact, if you are at peak time, it's a much better riding experience. When you're 2 people riding, you're never sure where like the light is turning orange. Do you stop? Do you go? What is the people like after you gonna do? And being 2 on the same bike is solving a lot of those issues and making it fantastic. And it's also absolutely perfect for families. So we see a lot of people carrying their kids, and it's the dream for tourists. You arrive in Nice, you want to go on the prom. La Promenade des Anglais is the big, nice streets where all the tourists would go, and you see a lot of like father with 1 kid, mother with the other kid, and they go on the bikes, and it's just simply the best experience.
I should definitely give it a try. I was CTO at Bond, where we built our own hardware, and I know what it takes to build a hardware, and I also know that it can kill companies, right?
Yes.
If you, and it can be a game changer for companies as well. If you look at Lime, I think most of their success today probably is linked to the jump deal. Looking back, probably it was one of the cheapest deals in the space.
Yes.
Right. I mean, for the incredible amount, for the incredible amount of time that Ryan and Tim, Nick spent over a period of time to build an amazing bike. It's a cheap deal, right?
Yes.
For you specifically, right? It could have killed the company if something went wrong, right? So you need to have extra, you should be super courageous to do that, right?
I think is the right word is more naive, if I'm honest. It's like
so it wasn't brave. It wasn't brave.
No,
it was
I mean, first, I think it's also a part of who I am as a founder. It's
Yeah.
like, as I said before, I have a calling to build, and so I wasn't there to just buy cheap bikes from China and try to make a buck for it. That was zero the plan. The plan was to make something that would change people's daily life, and I didn't felt like the existing e-bikes, and still today I don't think the big brand are doing e-bikes that are worth riding. So it was part of who we were. It was part of our DNA, but also it was clearly. I approached the thing with the opposite of like the Californian culture of hardware, which is very big team, designer led, a lot of processes, and we went the grassroots way, working with people doing competition mountain bikes for years. So people that did bikes that won World Cup in the 90s, so, and that lived in Taiwan in the factory. And so people with like a lot of grassroots experience, we talked to them and we felt like, those guys, they are making bikes that can win, world competition in very harsh environments, and we can trust their knowledge. And so instead of going with the Berkeley design degree, we went with people with barely any degrees, but a deep passion for the product. So it's a completely different approach, and I think we avoided a lot of mistake by being very humble and very pragmatic around like our hardware strategy. But at the same time, it's true that hardware nearly killed us, and it almost killed us because some of the stuff we did obviously was not right the first time. One of them, famously, is the battery. The battery are very hard to do, and we had some issues with batteries that forced us to remove the fleet in this entirety several times, so for several months. And to be honest, we almost didn't survive this, and we lost several millions in the operation, which at our scale is huge.
Exactly.
But still, I think it's a decision that I do not regret, because it's part of our reason to exist today. And I think in the long run, I think we're going to discuss what we think is the future of this industry. In the long run, I think if you want to reach the point where you can optimize your margin beyond a certain point, you need to know precisely how things are done to the factory at every machine level. And that's where we are almost right now. And that's why we think we have much better margin than, maybe with Lime, than anyone else in the industry on the e-bike segment. That's for sure.
I'm actually surprised that given that you were a quant trader, you didn't have a downside protection when building hardware.
Yeah, that's also part of what I had to live. I was I was not the typical quant, you'd say. So
okay.
It's true. We took on a lot of risk with this, but we felt it was the right move, and it's paying today. So.
But with the experience that you have so far, do you think there's a right scale at which companies can look at building their own hardware, or would you say that if you have the right strategy, you can get started with your own hardware? If you know what you're doing, you can get started with your own hardware, right?
Yeah.
Just to also put some thought around it, for scooters, maybe it's a different story because you have Segway and Okai that's very mature. If you build your own hardware, it has to be like substantially different from what they're doing. For bikes, I'm completely with you. I mean, you can actually build your own hardware, but for somebody getting started, can they do it from zero when they're starting up, or should they reach a certain scale before venturing into building their own hardware?
I think there is a notion of scale, because obviously when things go wrong, it's going to be in the hundreds of thousands, if not millions of euros to fix it, in terms of like like rebuilding the stuff and the loss, revenue on which you were planning in your financials. So both elements are like very costly. And so obviously, like below center scale, it's very high risk. So if it pays off, then it's great, but it may not. But I think, more than scale, what is key is the DNA of the company. It's like the kind of people you have with you and how much of a bootstrap grassroots culture you have, And I feel like what was really missing in the industry early on was like this zero grassroots, this zero bootstrap culture, which it was the opposite culture of like the going full blitzscaling playbook. The blitzscaling playbook, it doesn't go well with hardware because hardware takes time and it takes like a lot of serenity, which you don't have in this culture where the only thing you're after is growth, and so we've seen some of our competitors announce like they've done their own hardware and they would show pictures, and sometimes they wouldn't even produce a single one, and it happened several times. And because like they were so in a rush that they would design something poorly, they would build a prototype and they would announce it to the press before they even test it properly, and then they test it like, oh, see, this thing is crap,
I can think of two large companies.
Yes.
I don't want to name them, but
yes,
they
but
had
we
such an
know they are.
announcement.
Yes, and yes, and so and with teams that in fact are like, that we spend a lot of money and to get to those results, So I think it's like building quality hardware is really is a function, whether or not it's a good idea is a function of what kind of founders you are yourself and what are you after, And we knew very early on that not being able to raise the massive amount of capital that the competition did raise, it was part of strategy, but also if we could have, maybe we would have, if I'm being honest. Not being able to do those big raise, it forced us to be very bootstrapped, very frugal, and I think it's the right way to build hardware, taking the time and having a long-term horizon.
I mean, you mentioned that you have a finance background and all that, and you were interested in electronics. I remember 2018 or 19, we met in Paris. I don't know if you still remember this. I was trying to build an IoT company, and we had a chat, and I was like super impressed with the amount of knowledge that you had. I mean, you were like, you knew in and out of how to build a bike, right?
Yes.
So that's impressive. Tell me this: you've been around for quite some time now. Where are you at today in terms of size? Where is Pony today in terms of?
Yeah, it was a bumpy road, if I and but right now we are in a very good situation. We've passed last year the 10 million euros in turnover mark, which is quite good. It's 3.5 million rides, and with very good margin level. So again, like not having the choice means we had to focus on hardware, quality of hardware, quality of user experience, and free cash flow before scaling. Otherwise, it would crash right away. And so we if you take adjusted EBITDA, meaning you remove like all the exceptional stuff related to hardware and batteries, we did make EBITDA positive this year and last year, and 2025 so far is a very exciting year. We are up 70% year on year since for the first 5 months this year. And the target is to be something between 16 and 20 million in revenue this year. But the real objective is to get to bottom line positive. I mean net result, not even EBIT. Net result is key for us because, as I said before, in the long run, to keep growing, you need to be able to have financial partner financing your capex, and this requires equity, and
Yep.
so burning your equity is not going to work long term. So you need to be able to make sure you keep your equity. You'll be able to leverage it, and you'll be able to organically increase it and leverage it further and grow this way. So that's where we stand grossly.
And you will be a bit positive this year, right?
We hope.
I mean, 2025, right?
Yeah.
What's your depreciation timeline for your assets?
So it's about 4 years to the scooters and 5 years for the e-bike.
Okay. 5 years is pretty decent. I mean, I think these assets last much more than 5 years, right?
Yeah, in fact, if you look at the first batch running that launched in 2020
Yeah.
is still 80% or 90% running, and
Wow.
in fact,
Okay.
the frames are basically impossible to destroy. If
Yeah.
you outside of accidents, sometimes one bike being stolen, which is very rare, or vandalism, which happens in wave. Most of the time is basically zero, but from time to time,
Yeah.
you would have a wave, and for a few months, so outside of this, those bikes can run for like 10, 15 years,
Yeah.
and you need obviously to swap all the parts as they go. But yeah, no, they have very long lifetime, and
Mhm.
it's actually a key aspect of the V2 of our double pony is to make it such that it's extremely easy to uh, make it look new.
Okay.
Because again, those frames are so strong, it's
You can
sad that
repaint them and right.
yeah, and so
Yeah.
repainting is very difficult in Europe. I mean,
Yeah.
scrapping the paint and repainting is hard. And
Mhm.
so what we do is we find some clever way to by changing a few parts, making it look brand new.
Mhm.
But yeah, you're gonna see that in September.
Perfect.
Yeah,
I know that you raised about 23 odd million, right?
yeah. In
And
our last round, yeah.
yeah, that was a massive milestone. I mean, I think I did tell you as well that when everyone was like fearing about raising funds, I mean, I had like smaller companies texting saying, "Hey, I mean, nobody's funding. What do we do?" And then you come out with a 23 million fundraise when
Yes.
nobody was expecting. I mean,
No.
everybody thought, "Hey, Pony is like retracting
Yeah.
from other
Yeah.
countries.
Yeah.
Are they even still operating?" Other, people outside of France, they don't really know the scale at which you are
Yeah.
and how you're growing, right?
Yeah.
So, can you tell me about that fundraising? How that came up?
Yeah. So basically, we've been working on this in 2017. We've been consistently improving, and we've been also consistently working with cities. And so that put us in a situation. So that puts us in a situation in our market right now. So we focus on France and actually the French part of Belgium, so the French-speaking part of
Yep.
Belgium. In those markets, we've been the same team, the same people, meeting cities every 2 months for 7 years now. And so we know where the market is going. We know it's growing. We are very well positioned to increase with the market.
Yep.
In fact, we've won over 80% of the tenders in France in the last 3 years. We've been very consistent in terms of um, doing what we said we would do in the city in which we operate. So each of them is a net promoter of our service. So it felt like there was a huge opportunity about to bloom, and we were ready in terms of margins, operational knowledge, and to seize this opportunity. And so we felt like, but then we felt like to seize this opportunity properly, there are some investments that we need to do, like ISO certification of this and that, doing external, charging infrastructure, for this, and I mean a lot of R&D project to make sure things are like robust and may not break ever. And so to do this, there was like a bit more capital needed, and we also needed more debt financing for our vehicles. We felt like, as I said before, Adopt was a key part of our DNA. It is a key part of our DNA. But it felt at the time like a lot. It was a lot of is bringing some constraints that we wanted to remove for a period of time so we can go faster and go up a notch. So we went to start the discussion with asset-backed lenders first. That was beginning 2023. And quite quickly, actually, I was surprised by the appetite for the space. And so we actually received several offers, some much bigger than the 10 million we announced, but with different structuration that was not as fit as for our business as the one we decided to work with. Then one of them, Smart Lenders, was the perfect fit of, in fact, single-digit cost as well.
Oh wow! Okay.
It's very well suited to our business, meaning like it's a 2-year grace period, it's 3 years payback, so 5 years overall, which is perfect for the lifetime of the asset we're trying to finance. And it's very flexible and a company that's extremely pro-business. So it felt the absolute the best partner for us at the time. And then once we had this deal ready, obviously we needed the equity part to put in front. And be able to call this debt, and so that's where we started like a fundraise, which was extremely hard. Took over a year as well. I think close to 180 meetings to close. So that was
180 meetings.
Yes.
How many recharges? Probably 500.
Yeah, it was done by the bank. But it was terrible, honestly, and no one wanted to look at the space. But eventually, we found people that what we realized what happened to work was that the people that joined us were not typical VCs looking for the 10x, 100x return. Those guys have moved on to AI already, and they are not looking at our space anymore. It's finished. What we found is people that are like strategic interest in the space, or that were like impact funds, people that were having like a mandate to invest in the space, or in fact the lead being like a crowdfunding platform, which resonates again with our DNA of community, of having users and citizens as part of helping the business grow. And that's how we structured the round, with people that have like vested interest in the success of the service beyond simply financial returns. And so but it was a bit of an odd deal, but it's a very significant amount, and especially at the time. And it gave us a lot of freedom to deploy a lot of very interesting projects. I think we started working really in September, so most of this is not out yet, but I think you will see a lot of things coming from us in the coming months. So
great. It is impressive that you also did a single-digit interest percentage deal. I think it's just Voy and you that I know that have a no, at least for now. Now I know that at least 2 companies have a single-digit interest percentage deal, which is kind of very difficult in this space, right? Do you think that's because you have more e-bikes in the mix?
No, I think it's because we have better margins. Simply, it's and I know as a fact and that is why is because we didn't end up overspending in excessive fleets. So the fleets that we run are rightly sized, so they get higher usage than the standards of the industry. And we also are like very frugal and making sure as well we have the right warehouse at the right time. When our competition is fighting like crazy for the milestone cities,
Yeah.
then you would go overboard with like, stupid stuff,
Yeah. Yeah.
and those things are costly and overall, and then you see it in the bottom line. And so
Yeah.
what I think uh, is like we were showing several years of good margins and improving margin every year consistently. And that was the key element is like, I mean, we are not going for the crazy deals where we're going to lose money. You're never going to see us in London or in Berlin or whatever. We are going to go for the cities where we know that we can operate in a sensible way and
Yep.
in an environment that allows us to make money.
See, if you look at Bird's financials, it's out there. People can deep dive into it. I mean, the quarterly results when they were listed. What is very clear is that gross margins are very good. I mean, I keep saying this. Gross margins were really good. Just that if you look at every other metric, they were out of place, right? You being a financial guy, right? Can you explain why this specific business will work purely from a numbers point of view? Because I mean, if for people who know the business, they know that it works, right? Given the margins and all that. Can you paint a picture on what an ideal business is in the space in terms of how it breaks down?
So I think it's like I think the wrong intuition people have around about the space is coming from the fact that in the blitzscaling strategy, part of it is that you have to go fast and first. First, because you assume there is a first mover advantage, but also because capital itself is a moat. And if you read, I don't know if it's still live, but at the time, David Sachs, who led the Series B of Bird at 350 million, which is the round that put them as a unicorn, he wrote like a Medium post about the rationale behind the investment and why the fastest startup to reach unicorn status would be a hardware company, which is retarded. One of the key arguments is capital itself will be a moat. Now that we've done this deal, almost no one else can raise money. And this means that you raise excessive capital, and then this capital you have to provide a return. So you have to deploy it, but and you also have probably to find a way for your investors to exit. So you have to work on the next round. Series B investors, they don't wait for IPO. They want to be bought out by Series B, Series E investors. So you have to frame your business for the needs of your existing investors that put a lot of money behind yourself, and for those of the Series E investors and their intuition of what is a good business, which is completely unrelated with what is a good business in hardware in a capex intensive industry like ours, in my opinion. And so if you look at Bird financials, what I think for me as a finance guy, I was never able to understand is like how can you spend so much on G&A? It's like, what are you doing with the money? To be honest, it's more like, is it, are you defrauding your investors? How can you spend so much? Well, and at the time we were winning tenders against Bird with a team of 10 people, hardware team included. We reached 2 million of revenue with one developer based in Brazil.
Wow. Yeah.
You see what I mean? It's like, and we were facing teams of like hundreds of developers and doing who knows what, given that in fact, from a functionality point of view, the Pony app is like right now is 4.8 stars on the App Store, and it's more download than VoIP by a significant margin at the moment, and we only be and I don't even mention Bird, but and in terms of functionality, we are not only matching but ahead. We had a group ride before anyone but Lime. We had reserve before anyone but Lime. We had adopt a pony, which has like a very complex stuff in the app. and yet we were doing that with just one guy in Brazil,
Yeah.
And so what I think is like you want to have like the fundamental of the business are like, as you say, they are working, well-managed bikes and scooters. They are going to do, depending on the city, between 50 and 70% gross margin. And they are going to make you, Lime, they say €6 per day, I think is a good number. Some of our best city right now in summer, they would go as high as €17 per day in average
wow.
over the full week. So that's our best city
Wow.
last week,
Yep.
So it happens, but overall, I think if you manage to do 2.5 something rides, and then it gives you like €6, and I think and you are very happy with this.
Yep.
And then
I don't think a lot of companies are doing €6 per day per vehicle. I mean, Lime is an exception. If you look at Voi, I think they are at like close to €3.
Yeah.
Dot probably in that range as well.
But I don't think Voi and Dot can make money at all. I think we will see what Voi is saying, but I find it fishy that with such a low usage, you make money. So I don't know. I'll be interested to see, but I think there probably some reporting shenanigans here. Where I don't know. I have doubts. I wish. I really hope that they manage to reach profitability, and we cannot afford to have more company failing in the space.
Yeah, but I mean, no, if you look at Voi, and at least for Voi, their numbers are public now because the bonds are listed. So we at least for folks who are interested in numbers, we can deep dive. So coming back to your the gross margin, so 50 to 70% gross margin. I mean that's pretty good. And how would the other metrics stack up, right?
Yeah, and then depreciation, it's somewhere from 10 to 15%, and then from there is everything it goes to you. So you have like a bit of like fixed costs running your city, but it's very minimal. So maybe you lose like another 3-4% there, and then the rest goes to your HQ. What I think is the right model. I think you have like as little local operation as possible. Obviously, all the maintenance needs to be local. That's pretty obvious. But then I don't think you have like a full team of like city manager and city relationship manager, and so locally, I think is quite. You cannot replicate HQ function in every city. But then HQ is so you need a lot of tooling. That's something we invested a lot in. Having the right automation to make sure like things are running pretty much, with close to no human interaction, and then you have your team only to handle issues or unexpected events or supervision.
You'd probably keep your R&D spend less than say 5%, or something in those lines, and maybe G&A 15, 20, or maybe even less than that.
Right? Less than that.
Okay. Okay. And what did you project as a very good EBIT percentage? 7, 5?
Yeah, I think more than 7. I think.
Okay. Good.
I think it's feasible to be between 7 and 10. I think.
Okay. Yeah, I mean, if a company would get to 7 and 10, that's I think a really good number. I mean, Ride reported, I think, what was it, 20% last year, something like that. Insane number. But I think 7 to 10 is like a decent number to target for companies.
And but I don't think it's that aggressive.
Yeah. I think
but obviously, again, it's a matter of like the way you structure your headquarter and the culture you have, like and so
got it. In terms of future, right? We see that there are large companies, for example, Lime, Bird, now Dot Tier, right? So that there are a bunch of large players. If you look at global players, I can name just one. I think Lime is a true global player. Bird retracted, but now they're also expanding to Europe. I mean, it's still questionable if they are a true global player, right? If you look at Europe, you have Dot Tier, which merged, and you have Voi and Bolt, 3 top players, right? And you also have like similar players in Asia as well, right? If you go to smaller towns, there are multiple players, right? How do you see this market evolving? I mean, would you see, for example, I don't know, 2 or 3 global players, 2 or 3 regional players, and then multiple smaller players. How do you see this market?
It's difficult to say. To be honest, I am not so confident about the future of the big players. Again, it's not something I'm wishing that they fail, but I'm fearing. I have a lot of fear that the liabilities they have accumulated so far will be too hard to overcome, especially given that all of them are under huge pressure to bring liquidity to investors, so simply because of the mechanics of VCs, once you raise from a VC and they need to get their money back in 10 years, and maybe they can expand once, twice, but after 12 years, it's becoming a real problem. So those guys will be soon, or already are, I think, and ourselves included, actually. We started, we did our first VC round in 2019, and it's a question, how do we bring liquidity to the first investor? So,
but do you think there's real pressure, because most of them would have marked down their investments by now, right?
But I think Dottier, they got 60 million again, so they didn't write it off completely. I think. I don't know.
Okay.
In any case, I feel like there is the question of exit is going to drive a lot of decision in the future, but it is not clear what can be done. Lime is, I think, the only player that is a real shot at an IPO. Although they announced recently that they would. I think he was planning for 2015, and they canceled this plan. So no one knows why.
2025.
2025, sorry. Yeah, sorry. And I think from the rumors, I am not the LP. That's part of so I don't have the full details, but from what I understood from the rumors, it's been postponed. So.
See, I want Lime to IPO, but the thing is, Uber owns 20% of Lime, right? And if Lime is really cash flow positive, I don't see a reason why they should IPO. Because I mean, I think Uber. I don't want to get into the specifics of the Uber Lime jump deal, but what I understand is that there are clauses that probably would give Uber a preference over taking. I mean, if in case there's a liquidity event or an M&A, probably Uber probably has a first say in taking over Lime for a certain price, right? Given all that, I don't see an incentive for Lime to go public, although I really want somebody to go public, right? But it's difficult to say.
Yeah, but quite frankly, it's a bit above my pay grade. I don't have the specifics. It's possible that whatever option Uber may have is I don't know if there is a time limit to that. So if you have to, eventually have to pay, then why no more than why not late? Why not today? So I don't know. What I think is to go back to your question about the future of the space, what I think is in practice, there is very little economy of scale. And
why do you say so? I mean, I would imagine that the tech that you build, right? I mean, definitely if you're in multiple cities, right? It's the same tech, same hardware, right?
Look, we bought the tech from scratch.
Yeah.
With just one dude, and in fact, you can get this tech off the shelf. So it's not going to be just as good, but you have players in Ireland winning tenders with off-the-shelf scooters, off-the-shelf tech. So so the tech, yes, is it's not a complex product, from a technological point of view. It's in fact it's as simple as it gets. You don't have massive volume of transaction. Even Lime. It's something that you can run out of two Mac Studio. It's not even, you don't even need a proper server to run Lime full infrastructure. So obviously they probably over-engineered the stuff completely, and we did the same. So our backend cost is way higher than it should be. But if you look, the full micromobility number of transaction per day is it's probably a few minutes of Twitter. You know what I mean?
Yeah, that's true.
Yeah. So So it's not a complex technological problem. So whoever is telling you need a team of 60 people, you send them my way, and they can come visit our team. And then beyond that, where do you have economy of scale? The vehicles themselves, the industry, the bike industry and the scooter industry as a whole is optimized for low volume, so the bike factories are changing production every day. And so if, in fact, I pay my scooter probably the same price as Bird. So they probably have a discount, but even if they have like maybe a 20% discount, which I know as a fact they don't. Then, as I said, depreciation is 10 to 15% of the bottom line. So they would save, 20% of 10% is 2%, best case. So, okay, it's not zero, but it's not game changer. And then beyond that, operations are essentially done at city level. So the fact that you're very strong in San Francisco is not going to help you in South of France, So you need the right warehouse, you need the right team. And again, the tech stack, so it's true, you have a lot of automation and a good tech stack to build, but the fact that we built it demonstrates that, it's not that hard, And so, and I feel I have zero, data showing me that bigger players are doing a bigger job, and they've learned because they've done so many cities, they've learned a lot of stuff. No, they have more cities and they have more headaches. And if you look at the history of Uber, in fact, it was almost a franchise at the beginning. So the different countries, they would have their own team entirely. They would not share a single line of code almost. And it was completely different because otherwise, if you are like, I don't know, let's say Romania, and you want to prioritize your features in the global roadmap, you're never going to have your features implemented, And so, and in fact, if you look at Uber itself, it went the way of building local entities with a lot of ownership. And then later on, eventually they consolidated and save cost and everything, and create a more global experience, which they didn't have at the beginning. But it's not true factually that you have like a lot of advantage being big. And so, in fact, having this in mind, the right model, it feels like there's a lot of value in local knowledge, knowing the right events, the right places, the right partners, the city officials. So in fact, there was a lot of sense in what Bird tried to do with their franchise model. The problem with the franchise model is it requires a business that's very easy to run. Franchises, they are in a way entrepreneur, but it's not the same as like really starting your own company, meaning that they don't have the ability to really change the business model deeply to adapt to the specific of their market and to make it work. And so, and in fact, Bird Canada did, but in France, for example, every city had like a franchisee, a small franchisee, and those guys were really struggling because the business was not mature enough for them to make a living and in good condition with good reliability. But in the long run, from a theoretical perspective, it does make sense that this would be the right way to do.
Jet is doing it, right? Jet is doing it. Swing is doing it, and they're profitable, right?
Yeah. So I think is so in fact the big player then the question is, are they too big to fail? So they are so big, and in fact that maybe it can keep going like this for a long time. I don't know if there is room for 5 of them. I definitely don't see Lime disappearing. But again,
like Bird as well, right? I mean, they completely going through Chapter 11 restructuring, and they had like 20 million EBITDA last year, and if they continue to grow that way and probably raise capital as well, because now it's a clean company, right? They probably can be around. We have Void, Teardot, and Bolt. We'll have to see how they'll navigate. I mean, why? At least the numbers that we see in the quarterly filings, they look promising. I still want to see the Q2 numbers because I see some sort of a margin compression going on, and if that continues, it I mean, it doesn't make a lot of sense. So Q2, Q3 is going to be very important. For Tier Dot, we really have to see how the turnaround is, going to play out. Right? We'll see. But too big to fail, I'm not really sure. But I have a feeling that I think most of these companies, they'll survive. I mean, I'm with you that they have to survive for the sake of the industry.
Yes.
But at least some of the metrics that we are looking at, they look positive.
What I think is very positive is more like you had an interview with the guy from Ride and stuff like this.
Yeah.
These guys, I think, is really those guys are making what, 80 million?
I think last year they probably did close to 50, and maybe 2025. I'm guessing they should be around 70 million, or 70 million, which is
So I think those guys are like, I think is really showing that when done properly is going to work. And I if someone needs to have like reassurance about the industry, I mean, you look at those guys and you look at their users and you look at how much their users rely on those services for their daily life, and you're clear that it's not going away, right? No, what is the future? I think, that the industry, it didn't have its iPhone moment yet. So I was listening to your interview of the Bird CEO earlier, like this afternoon, actually. Yeah. And he was saying, for us, like a good user is 3-4 rides per month. For us, the same, you have like some crazy users that would spend like 100, 200, sometimes 300 euros per month. It does exist, but those guys are like, this is definitely not the majority of our users. For the rest of them, they would use it 3-4 times a month because that's what they can afford with their budget, right? Yet they typically, people do between 70 to 90 trips every month, right? So what we do is 3% of those trips, even though for the vast majority of those trips, the service that we provide is the most convenient way to move around. If you don't have a way to park your own bike safely everywhere you go, having your own bike is very tricky these days. I think everywhere in Europe, you have massive problem with bike theft. There's a real deterrent for people to use bikes. And then micromobility inside city centers for trips between 15 minutes is the fastest, most reliable, and most energy efficient way to move around. And so I think it's like we need to find a way to make our service the way people move around every day. And this is a budget problem. People, they have a budget. It's like in France, it's about 13 to 40% of their budget, of their disposable income is spent of transportation. Some of it being like different stuff, but most of it being day-to-day transport. And we need to find a way to fit within this budget. And if we do, the industries in France only is billions, and in Europe is dozens of billions. And it's a 100-fold what it is today. And I think there is a lot of, it's also the reason behind our funding is to work on how do we make this happen. And part of it will be keep working on margins, keep improving the margins to be able to bring the cost down. And then also work better, I think, with cities to make our service part of really the public transit offering on their perimeter, and so to subsidize it concretely the same way they do with the bus or the train,
or even traditional the station-based bike share, right?
Yeah, exactly. And I think this is so working on margins, so improving the vehicles, improving efficiency, increasing battery size, lowering breakage rate on one side, and on the other side, working with cities to demonstrate that we are more cost efficient and energy efficient and environmentally efficient way to move around that any other form of transportation, including public transit, and that it makes sense. It does make sense for them to subsidize our service and allow it to change from like this occasional stuff to my main daily driver.
Got it. So what you're saying is that just in France, it's like a 2 billion market that's
So
still
if
waiting
if
to
you
be.
look at cities that are more than 50,000 people, okay, so relatively big cities where using micromobility does make sense. If you go below that, then maybe that doesn't make sense. But yeah, okay. And you assume that you can get 10% of the trips done in those cities. I'm not very aggressive. And you assume that you charge €1. Okay. So a
which
third
is
of
also
what
lower number.
which is a third that we charge today. That's 2 billion.
Wow. Okay, that's just in France and
That's just in
conservative
France.
calculation.
Yeah, just in France.
And if you put enter Europe together, we probably should be around easily 10-15 billion, right?
Easy. Yeah.
Wow. Okay. Super. It took longer than we expected, but it's an incredible chat. I would love to keep going on, but I want to be conscious of your time as well. But amazing chat. Always nice chatting with you. Do you have any final thoughts? Anything that you want to tell the audience?
No, beside the fact that I'm lucky to be able to join you and the whole industry at Micromobility Europe in Brussels and next week. So I hope I don't know when you plan to publish this podcast and if people will get to listen to it beforehand. But if people will want to come and have a chat, I'd be happy to do so and to dive even deeper in all we discussed today. So.
Yeah, for people whom I meet in industry, I think to everyone I've offered to introduce them to you. Introduce you to them because I strongly believe that everybody should have a chat with you. I always love our chats and the depth of knowledge that you have is incredible and something that I also have to appreciate is that a lot of folks gave up in the last years and it was tough for the industry and you persevered. And you're still around, and congrats on the massive raise. And you are definitely in the top watch list of mine.
Thank you, Prabin. And I hope soon we'll have to be able to publish positive net income and make a big celebration of like us getting to the next milestone in our journey.
Yeah. I'd be the first one to write. So. Cool. Nice chatting and looking forward to meeting you at Brussels, Micromobility Europe, Brussels. And congrats on everything that you've achieved so far.
Yeah, and
thank
I
you.
guess like everyone as well, I want to thank you, Prabin, for everything you're doing for the industry as well. So not only organizing the conference, taking over micromobility industries in part to make it a success and and being the voice of like hope and for this industry that I think has still a lot to bring to everyone around the world.
Hope is all we need. All investors, founders. We need more people to build in the space. Investors to invest in the space. And but thank you for your contribution to the industry as well. And looking forward.
Thank you, Prabin.
Take care.
Have a good day.